Hey everybody, welcome to the morning market briefing Thursday, May 19th, 2022. Hope you guys are doing well. Ugliness in the markets. We're going to talk about some of the reasons why. Look at the themes. Obviously, just an absolutely brutal day yesterday, Ben. It seemed like there were no buyers. Futures down close to 1% right now. Describe kind of at a high level before we get into some of these specifics, what you were seeing, especially late afternoon. It seemed like we just couldn't catch a bid on anything.
No, there was no bid on anything. There wasn't really. I mean, once we had that additional downdraft down to about 4% on the S&P 500, wasn't really much seller either. There was very much apathy in the market, which is a good sign in terms of that capitulation sign. It's unbelievably painful though when it's happening, and that's what we experienced yesterday. And there was just no buyers out there. It was kind of a buyer strike on stocks, on the NASDAQ, especially on all retail stocks. There were a lot of retail stocks just went down immediately on the open and then just never moved the remainder of the day.
Yeah.
And we'll talk about a few of those, but yeah, it was a brutal day yesterday.
Yeah, it was ugly all around. There really was. I think the thing that was challenging is there was really nowhere to hide. You and I talked probably a little bit before lunchtime, probably around 10:30, just looking through portfolios. And it was kind of one of those days, to be down as much as the market was and to be, kind of where we were in terms of positioning. In theory, I would say, oh, here's probably what hurts me. But a lot of that, like Staples got hit. Procter & Gamble down 6%, Pepsi down 6%, Coke down 7%. There's nowhere to go. But the retailers certainly were ugly. Target closing down close to 25%. Costco down 12.5%. What's your takeaway? I mean, obviously there's a read through on the American consumer as a whole, but what's the narrative currently as you see it for retailers and any read through there?
I've never seen options like we've seen on Costco yesterday on a retail stock like that. The number of people betting against the company. I mean, at one point, it was in the middle of the day, I checked, and it was about $425 million notional short that day on the put options on Costco. People just absolutely trouncing it. And these are options that expire on Saturday. So you basically have 2 days to actually get into the money. So people are really counting on Costco just getting crushed. After they're already down so much from the high, they report earnings next week.
They're up a little bit pre-market.
I do think that a lot of that put buying was a little bit excessive. I think that right now people are looking for the next thing, and they're just, we got these people hunting shorts right now. They think it's free money to go out to name that retailer and just fire off some shorts, collect another 3 to 5% when that stock tanks, and then move on to the next one. And that's what they're doing. They're rolling the Target money from the Target short into the money from the Walmart short and the Target short to the Costco short. I mean, it just keeps going. And I think that what we saw yesterday was the shorts were very much emboldened. That doesn't mean to say that we're going to get a big bear market bounce soon. But I think that we increased the odds dramatically yesterday of that. And so I know I've been saying like kind of we're at the beginning of the end. And I think we're still end of the beginning in terms of,
he does that every time.
I can't keep it right. But I think we're still in act one or act two out of the 5-act play fundamentally. But in terms of the markets, I think that we're priced in a lot. And I think that when you see shorts get emboldened like they were yesterday, that's when, and bulls are nowhere to be seen. That's when you start to get closer to flipping that switch and saying we could be setting up for a rally.
Yeah, I mean, I agree. We talked about this. We all kind of hung out and chatted last night. I feel like economically and on a fundamental level, we've not seen the bottom. And you see that even in the commentary from some of these businesses that seem to be looking at different time periods or different phases, perhaps, of decline. On the market level, I mean, I really do think the sharp decline that we've seen, including the puke yesterday, I think more damage has been done on the market level than would be, reciprocated by the economic level, in my opinion, which stands to reason that we could see, slight deterioration on the economic side, but not see as much of a market push down. We've got Under Armour down 7%. Yesterday fell another 5% pre-market today. Their CEO is rolling out. Patrick Frisk stepping down. COO will be the interim CEO. This is a company that's just languished for a while, and obviously is not going to benefit from the current economic conditions. Ben, how much of a hit is that CEO transition? Obviously, the market's pricing one in, but I think the market's looking for reasons to punish anybody that can.
Yeah, and I think you just hit the nail on the head. I mean, they're just getting crushed right now as a result of it. They'd probably get crushed if it stayed. Is one of those things. It's really difficult. I haven't followed the Under Armour story as closely as some other stories. We don't have any investments in Under Armour, so my view on that, take it with a grain of salt. But it's weird. He's going to be staying on as an advisor. He was allowed to comment in the press release, yet he's stepping down on June 1st. So it doesn't seem like he's immediately going to a new job because he's going to be on it as an advisor through September 1st. But at the same time, it's just very difficult to know actually what's going on with that one. I want to go back to Costco really briefly for a second, because I do think that when we talk about the baby getting thrown out with the bathwater, that's a great example of it. Couple things where Costco differs from Target: much less inventory. It carries half the inventory that Target does and 2/3 of the inventory Walmart does. So you have a lot less risk of write-downs. We already know the revenue number for Costco. We don't know what the cost number is going to be. We know the revenue number is going to be that for that. You have membership fees. A membership fee hike is likely in the next few months. And you have a gross margin standard deviation, which is the lowest in the S&P 500. In fact, they actually grew margins in 2007, 2008, 2009, and 2010. So it's an extremely robust business, but it's getting thrown out with the bathwater with Target. So that's the type of analysis that we're doing. But right now, it doesn't matter what you own, because if it sells something to a customer, especially a consumer, it's getting hit. Like Andrew said, Coca-Cola was down 7% yesterday.
Yeah, it's crazy. And then you've got just this odd disconnect, it seems like, between what management teams are saying and what they're actually doing. Perhaps no better example of that than Bath and Body Works, down 8% yesterday, down 7% today. They cut their EPS guidance pretty significantly. So they're expecting EPS range of 380 to 415. Previously, it was 430 to 470. And yet they have the gall to come out and say things like, our business is very strong, our execution is excellent, and our strategy of delivering affordable luxuries to our customers is more relevant than ever. Both of those things can't be true. You can't say, hey, profit's actually going to take a pretty sizable haircut to the tune of about 20% per share, but we're crushing it. We're performing well. Our execution's great. Strategy is delivering as expected, and customers love this. There's just a massive disconnect there. Kohl's, another shock here. EPS down. Stock was down 11% yesterday, down another 3% today. Not as big of a revision as maybe we saw from Bath and Body Works, but still, just definitely leaning into the theme we've seen with these retailers.
First one that I've seen that's really cut down on revenue guidance significantly. Now sees revenue up 0 to 1%. Previously, they thought it was going to be up 2 to 3%. What's interesting, they're trying to sell the company. So they've been working with Goldman. Apparently 25 parties are interested in the deal. I think that's what's kind of keeping the stock up a little bit this morning. I wouldn't be surprised to see those parties quickly fade away and say, no, thank you. I feel like Kohl's has been trying to sell the company for the last 10 years. They say that they had a really good start to the year, but sales weakened, quote, considerably in April due to, and they called out the inflationary consumer environment. So the first company that's actually calling it what it is, which I don't know, maybe shows that they're relatively weak versus the others, but could also
maybe they're honest.
Maybe they're honest.
Yeah. Nowhere to hide. Cisco reported earnings yesterday. Relatively good profile in terms of gross margin. Their commentary, I know you liked it a good bit, Ben. So that was kind of the good side. Lots of uncertainty, though, not only on just orders at large, but also as it relates to Russia and Belarus revenue. And the COVID shutdown in Shanghai really having an impact there. How would you kind of assess where Cisco is now moving forward?
Yeah, Cisco is really tough because I'm tempted to. What management basically said is that they're doing quite well. The reason that their results in the quarter weren't so good was because they stopped selling in Russia and Belarus, which is only 2% of their business, but that's a 2% hit on revenue that flows through. Good things that are difficult to square with the company is orders definitely did decelerate in the quarter. However, you can't square that with gross margins that are continuing to be healthy and commentary that there is zero demand impact relative to analyst expectations. In fact, one analyst actually said, relative to analyst expectations, what is the demand impact on your updated guidance? And they said zero. It's 100% supply. And basically what they're saying is that they have a bunch of, call it routers, switches, that they just need power supply components for. And Shanghai has been locked down for a month. Their quarter finished in April. Shanghai locked down on March 27th. So a lot of their peers didn't have any impact on these Shanghai shutdowns, whereas Cisco had a whole month of that, which really dramatically hit revenue, and it's going to hit it in the next quarter as well. So Cisco is really kind of a black box, kind of like it switches right now. The thing is, it's a cheap stock. It has a 10% free cash flow yield, which means that every year that you own the company, they're paying you, they're generating 10% free cash, which is a nice business to own. And so we want to own businesses like that. And it's down a decent amount pre-market, but I do wonder if that's an opportunity here. And the valuation says that it does. Their commentary says that it does. The question is, are they adequately addressing potentially another shoe to drop in demand if this recession continues?
On the economic front, China in talks with Russia to really bulk up their crude oil reserves. It seems as if they have capacity. According to satellite images, the expectation is that they can store over 1 billion barrels of oil. It's estimated that they're around 926 million, so potentially going to Russia to round that out. Not necessarily surprising to see these two link up and figure out a way to move product.
Yeah, I mean, they've already been buying. They've been buying since mid-March. Their stockpiles were 869 in mid-March. Now they're 926. They're looking to go even higher by taking advantage of cheaper Russia oil. By contrast, a lot of the Western world has actually been reducing their strategic stockpiles of oil. U.S. today holds about 538 million, but has capacity up for 714. And we're going to continue to get rid of oil for the next few months as we draw down our stockpiles in the U.S. So China basically becoming the buyer of last resort for Russian oil. So they're getting a great price. Russia's getting rid of its oil, and it's kind of subsidized by the releases from the U.S. from its strategic petroleum reserve, which you could argue is good from a humanitarian perspective. You can say we're doing the right moral thing. You could say that it's foolishness on a financial perspective.
Lastly, initial jobless claims, a little bit of a tick up to 218,000 is the number. I think it's going to become increasingly important as we look at some of the struggles the economy is facing.
Yeah, you could say the 218 is just noise right now. But right now, I think we need to be looking at noise, especially on the employment front, with a stricter eye, because that is something that we need to be paying attention to closely. We're going to watch that 4-week moving average closely. It's kind of bottoming out right now. And if we have a few weeks above 200,000, especially if we get above 250,000, that's where we can really say unemployment is probably going to start ticking up.
Interesting, data to kind of gel. Continuing jobless claims actually fell by 25,000. How do you think that's just people leaving the workforce and saying, you know what, I'm no longer looking? Like, what would?
Or maybe they need a job now.
Yeah,
I think it's probably they need a job now.
They actually have to take one.
Yep.
Yeah, that makes sense. We'll wrap it up there. We'll be back tomorrow at 8:30. Hope you guys have a good Thursday, and we'll talk to you guys soon.